Right now, the market is telling two completely different stories. You've got the obvious bull case, but underneath, the data and some big money flows are pointing to some serious risk. Here's the framework for trading it. So, you see the headlines, right? The Fed just cut rates. Seems like all green lights. But then, why is some whale out there betting millions that the market crashes by the end of the year? That's the conflict we need to break down. All right, let's get into it. First, let's look at the bull case. It's pretty straightforward, and it's really built on two big ideas: cheap money from the Fed and less drama on the world stage. First up, the Fed. They did exactly what the bulls wanted: cut rates by 25 basis points. So the new target range is 3.75% to 4.00%. What does that really mean? It's the Fed basically sending a signal saying, hey, we've got your back. They're willing to step in to keep the economy and, let's be honest, asset prices supported. And the second piece of good news? The trade war seems to be cooling off. You've got China backing off threats on rare earth minerals and agreeing to buy a ton of U.S. soybeans. The U.S. is dialing back some tariffs in return. For the market, this is huge. It takes a massive piece of uncertainty right off the table. Okay, so that's the bull case. Sounds pretty good, right? Well, hold on. Now we have to look at the other side of the coin. Because while all that big picture policy stuff looks great, the data from the real world, it's starting to look a little shaky. We're seeing some cracks, and it all starts with this government shutdown. We are now 29 days into this thing. And look, this isn't just some political headline you can ignore. This is a real, measurable anchor being thrown on the economy. It's hitting people's ability to spend money, period. And just how real is it? Tried this on for size. 42 million Americans. That's how many people are about to see their food stamp benefits just stop this weekend. That is a direct hit to the most vulnerable consumers. And you better believe that's going to show up in the economic numbers very, very soon. And it's not just that. For the first time, every single branch of the military is missing paychecks. Think about that. We're talking about a massive, widespread income shock that you just can't sweep under the rug. And if you want to see how this translates directly to the market, look no further than Chipotle. The stock got hammered, down 15%. Why? Because management came right out and said it. We're seeing a slowdown, driven by these macro pressures. Their customers are getting squeezed. I mean, when a company like that tells you what's happening in plain English, you have to listen. So the consumer data is definitely a warning flag. But there's another piece to this puzzle, another part of the bear case that's maybe even more telling. It's not about millions of data points. It's about one single massive trade. Somebody with very deep pockets is betting on chaos. Okay, here are the nuts and bolts. Someone bought 129,000 VIX calls with a 33 strike expiring in December. Now, for those of you who track options flow, you know that is a monster trade. It's not normal. This is either someone protecting a gigantic portfolio, or it's an outright bet that the VIX, the market's fear gauge, is going to absolutely explode before the year is out. And what's really interesting is this trader isn't alone in their thinking. The market itself is already expecting more turbulence down the road. You can see the VIX futures for December are trading way higher than the current spot price. That's a classic contango structure. So this huge trade, it's basically someone saying, I see what you're pricing in, and I'm betting it's going to happen, and then some. So what do you do with this? You've got the Fed on one side and a potential consumer collapse on the other. How do you trade that? Well, the answer is the market isn't one thing right now. It's not just bull or bear. It's split. It's divergent. And nowhere was that clearer than in big tech earnings. The game now isn't about picking the market's direction. It's about picking the right stocks. Just look at the tale of two tech giants, Google versus Meta. The difference is night and day. Google comes out, smashes revenue records, cloud growth is strong, boom, stock goes up. Meta? They also had strong revenue, but they got punished, down 11%. Why? Because they talked about spending a ton of money on AI down the road. The takeaway here is absolutely critical. Right now, the market wants profits today. It wants certainty, it is rewarding cash flow, and it is selling off these long-term trust us stories. It is a flight to predictability. So in a market this complicated, just going all in risk on or hiding in risk off mode is probably going to get you chopped up. We need a more nuanced plan. Let's walk through the scenarios and how to position for them. My base case is this. The market probably keeps grinding higher, but it's not going to be a broad rally. A few big names will do all the heavy lifting. This means it is a stock picker's market, 100%. You have to focus on quality earnings, not just the headline noise. So the posture is to be modestly long. You don't want to fight the trend, but you stay nimble, you pick your spots, and you keep some cash on the sidelines.
So what would change my mind? What are the key signals to watch? For the bull case to really take over, I need to see the economic data confirm this soft landing narrative everyone's hoping for. On the flip side, the bear case becomes reality if we see credit spreads start to blow out, or if the weakness we're seeing in the consumer spreads to other parts of the economy. Those are your tripwires.
This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. Okay, with that whole framework laid out, let's talk about a couple of potential options setups. These are designed specifically for this kind of divided market, using defined risk. All right, thesis number one. It's simple. The market threw a tantrum and oversold Meta after earnings. That 11% drop wasn't about the business today. It was fear about spending years from now. That kind of overreaction can create an opportunity. So a potential way to play this is with a bull put spread. You're selling a spread out of the money, below where the stock is trading now. The rationale is twofold. First, you're betting that the post-earnings panic is over and the stock will find a floor here. Second, you get to sell that juicy, elevated implied volatility that always comes after a big move. You get paid to be right, and your risk is defined. The invalidation level is crystal clear, a clean break below that post-earnings low. Now for thesis number two. This one is all about playing defense. It's about respecting those warning signs, the shutdown, the consumer weakness, that huge VIX trade. Think of it as buying some cheap insurance against the bear case, but with defined risk. And a smart way to do that could be with a put debit spread on the QQQ. Why the QQQ? Because big tech has been leading this whole rally. If things go south, that's where the pain will likely be felt the most. Buying a debit spread gives you that downside protection, but your maximum loss is capped at what you paid for the spread. It's a clean, efficient hedge. And if the market rips to new highs, okay, the thesis is invalidated, and you move on. Not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage downside, and verify all data.